I have to fess up. There are a couple of things I have not been forthcoming with about infinite banking. Aloha, I'm Stan Cox, principal broker and strategist with SC Finance Strategies and Insurance Consultants. I'm also the author of the books, Tax-Free Cash Growth Warehouse Strategy, and I'm the managing director of the Hawaii Financial Freethinkers Academy, a nonprofit financial literacy education organization. For the past several years, I have focused on and specialized in the infinite banking concept and tax-free cash growth warehouse finance strategy. And so if you find this to be helpful, please like this video and subscribe to this channel. And also please post your questions and comments here. I'm not making excuses, but one thing about these points I am going to talk about here is they do not hold true with all providers. And by way of explaining why I have not previously been talking about the points I will cover here on this video is because I just don't place their importance as high as the finance strategy benefits that I'm so passionate about with infinite banking. So here it is, and this is a big one. Designing a policy for maximum beneficial use of the infinite banking tax-free cash growth warehouse strategy requires that it be constructed using the smallest amount of whole life insurance that will meet the specific needs of the client, and then adding the larger component of renewable term insurance as a rider. Then, once the optimal balance has been achieved with those two components, we add in the paid up additions rider, again, according to the ability and the goals of the client. There are a couple of things that happen when the policy is designed this way, and herein lie the hidden secrets. Here's the first thing that I've not been real vocal about up to now. And if you've been following these videos for a while, you probably know about MEC limits and how combining whole life with term rider raises the MEC limit so that you can load up the cash value without losing the tax-free growth benefit. We have a video specifically on that, on MEC limits and MEC modified endowment contract, so check it out if you're interested. But here's what I discovered when I built my very first infinite banking policies. I was able to get 50% more insurance at the same premium level as I had before. And Amanda and I were 2 years older than when I wrote our first policies without this design. And that's a big deal because, one, age is one of the biggest factors in cost of premium. So being 2 years older when I exchanged our previous policies for our current infinite banking policies and getting more insurance for the same price, well, that was saving us about 50% on the cost of our policies. So the big secret here is a properly designed policy for infinite banking can save the client a bunch of money while providing a really excellent insurance policy. I'll show you the numbers in a minute, but I also feel I need to explain that this design option is not available with all providers, and the way similar designs with other providers work is also not the same. But those details are for a different discussion. Here's the other part of that same design feature with this same provider, who shall remain nameless here for legal compliance reasons. Each portion of the design has its own premium cost. Typically, $1 million of term insurance is going to have a much lower premium cost than $1 million of whole life insurance for the same person. And as we all know, term insurance never has any cash value, except when the insured person dies. Then the policy benefit is paid as a tax-free cash benefit to the beneficiaries. And that's one reason term insurance is so much less in cost. all other things being equal, except in the case with this particular provider. With this one provider that I use most of the time for these policies, the term rider that composes the larger portion of the insurance, around 92% of the premium for that rider, does contribute to the cash value of the account. It's amazing and unique to this provider as far as I know. Just to explain a little more, the term rider I use for these designs is an annual renewing term rider. The premium for the term insurance decreases each year because it decreases in face value each year. So the total premium remains the same as the client ages and the face value of the term rider decreases. Otherwise, the premium would increase each year as the insured ages, because again, that's one of the biggest factors in the cost of insurance, the age of the insured. But the total face value of the policy is not negatively affected as the term portion decreases, because the whole life portion is increasing each year as the dividends and paid up additions are purchasing additional whole life, which is being added to the policy face value. As a result, eventually the term rider will disappear from the policy altogether. So the big secrets I haven't been shouting about are that infinite banking designed policies provide life insurance at a greatly discounted rate over conventional whole life, while simultaneously providing accelerated cash value growth and availability. There, I feel better now that I've let that cat out of the bag. But again, all that I've just disclosed is not something that all providers offer, just to be clear. Now, let me show you the actual numbers from official illustrations that I've generated using proprietary software belonging to the provider I use most for these policies. Hang on a second here. Okay, here we're looking at the first 5 years of a $500,000 life insurance policy designed for a 45-year-old male with a standard non-tobacco rating. Keep in mind that this provider is a mutual company and the policy is a participating whole life policy. So it receives dividend interest from the provider. The standard whole life policy, that's this top one up here, has a premium of $10,945. Okay. You can see that the first year it has zero cash value, and the face value or death benefit is at $500,000, 500,000 bucks. Okay. The second year, a little less than 16% of the annual premium is attributed to the cash value, and the face value has increased by $5,357. By year 5, about 90% of the annual premium is going to the cash value, and the face value has grown to $523,305. The dividend interest is growing the cash value and buying little chunks of whole life insurance, which is being added to the total face value each year. And next, we have the value design, whole life, which in this case has about 25% of the total face value as whole life, and the rest of the $500,000 as the term rider. Now look at the annual premium for this $500,000 policy. It's only $5,000 $751, a savings of 48% over the standard whole life. And now look at the cash value. About 41% of the annual premium is going into the cash value the very first year. Now, again, about 90% in the 5th year of the premium is going into the cash value. So the difference between 14,170 and 1975 is about 90% of the 5751 of premium that's going in. You'll notice that the face value doesn't grow. It stays at $500,000 for the first 5 years. But it does start growing in a few more years after this. If I had extended the numbers here to show you, but we're just looking at the first 5 years for now. But still, roughly $84. This is the value design, and it stays at 500,000. The premium stays at 5751. Cash value grows in 5 years to $19,075. And now look at the cash value. Oh wait, here's the infinite banking design here. Okay, we're going to see some differences now, which includes the same proportion of whole life to term rider as the value design. But now we're looking at the infinite banking design. So what we've done is we've added just $1,000 a year of paid up additions, which is roughly $84 a month. So now the total annual premium is $1,000 more, $67.51, which is still a savings of almost 42% or $4,200 a year, or over 38% less than what the standard design premium is. Okay. And look at the cash value now. Okay, premium is $67.51. Cash value the first year, about 49% of the total annual premium is in the cash value the very first year. And you know, you can do whatever you want to with that cash value. When you leverage it with a policy loan, you can use it tax-free, no penalties, and the entire amount of your cash value continues to grow with the dividend interest. And look at the face value of the death benefit, all right? By year 5, you've got $515,305 of insurance, and the premium remains the same. Okay, so all this is, really great news for those who are just looking to get the best policy at the lowest premium. But as far as cash value and death benefit growth, we really aren't comparing apples to apples. The annual premium for this $500,000 policy, standard edition, is almost twice as much as the value and infinite banking editions. So let's compare standard with a more comparable infinite banking design. Okay, let's do that. I'm going to change this up here. Now, the top section here is exactly the same as what we just looked at, a $500,000 standard whole life annual premium of $10,945. This full infinite banking design is the same as before as far as whole life and term rider, but here we bumped up the paid up additions rider. So the total annual premium is much closer to what it is for the standard edition. It's $97.51 with the full infinite banking design, $10,945 for the standard $500,000. So again, the premium is actually $1,000 less, but it's close enough to see what a difference the design makes. Now, we have an annual premium of under $10,000, $97.51. And the very first year, the cash value is about 63% of the premium for the year. Wow. And by year 5, we have nearly 100% of the annual premium going in. And the cash value, okay, 63% going in, but it's increasing each year. Okay, so 100% in year 5, and we have $10,000 more in a cash value, $39,646, as opposed to the standard version, which is $28,352 in cash value. Also, look at how the face value has grown during this 5 years, right? We started 512,656. By year 5, we're at $561,221. Almost $40,000 more than with the standard whole life design. So you see that with the same, or actually $1,000 less than the standard policy premium going in as premium, by year 5, you have $10,000 more in cash value and $40,000 more in insurance, and the premium stays the same as in year 1. So you tell me, is this something I should be talking more about? If you have found this to be helpful, please like this video and subscribe to this channel. Also, please post your questions and comments here. For a more complete explanation of the tax-free cash growth warehouse finance strategy, you can watch our free 60-minute webinar. The link is in the description box below. The link to buy my books on Amazon.com is also below. And if you'd like to book a free phone consultation with me, the link to my Calendly page is below here. If you'd like to apply to become a client of ours, the link to the application is also below. We're here to help, and we look forward to helping you. For now, aloha and mahalo for watching.